day 2 of the MK conference. We hope you're having an enriching experience at the conference. As we continue with the engaging format across main tracks, speakers, company meetings, we are delighted to start day 2 with the management of HDFC Life Insurance. We have here with us Ms. Vibha Padalkar, who is a MD and CEO of HDFC Life Insurance Company. Vibha has been associated with HDFC Life since 2008. She's qualified as a member of Institute of Chartered Accountants of England and Wales in 1992 and also is a member of ICAI as well. Prior to her appointment at HDFC Life, she's worked in varied sectors such as global business process management, global FMCG, and in an international audit firm. Over the years, Vibha has been recipient of various awards which include the CA Business Leader for Large Corporates, BFSI, by the Institute of Chartered Accountants of India. She also has been facilitated with the award by ET Prime Women Leadership as well, IMA India, as well as has been recognized as one of the top 30 most powerful women in business by Business Today for 4 consecutive years. In 2021, Vibha has been recognized as one of the most powerful women in business by Fortune International and Fortune India magazine. Vibha will be discussing the evolution of insurance company and the roadmap to drive growth for HDFC Life. This will be followed by Q&A. Over to you, ma'am.
Good morning, everyone. Great to be here. I think all of us are very happy to be here physically, COVID or no COVID. I think we're just going to learn to live with it. Physical is always, I think we are all social creatures and physical is important, whether the way we look at our customers, whether we look at our employees and other stakeholders. Airlines are completely packed. I think all of us are traveling. I think just learning to live with the new normal. What I want to cover today, we have about 45 minutes. I'll try and stop in about 35 minutes and then maybe take some questions. What we've tried to do here is try and quickly recap where Indian insurance is in terms of its journey so far, 22 years of private life insurance. And suddenly, there's a huge tempo in terms of the opening up of possibilities. Some of it is real, some of it is being thought through, some of it will take some time, but I think what's exciting is that we're trying to triangulate where we have come so far with where we can get to. So my presentation is in 3 parts, a quick recap in terms of how things are changing, how some of the specifics of triangulating how Indian life insurance has evolved, some of the demographic changes, and so relevance to how we're thinking about our offerings and the way forward. So if we were to look at this, we are looking at fairly swift changes in everything from customer behavior, the customer preferences, and this has also been accelerated by the pandemic. People who were very diffident about buying anything online or transacting online are increasingly getting comfortable transacting, and insurance is no different. Yes, some of the higher ticket sizes perhaps still is very advisor driven, but otherwise we are beginning to see, at least wanting to be given a choice, wanting to be seen as being in the driving seat. Earlier, and not so long ago, insurance was a B2B business, and the C was an afterthought. Now C has at least an equal stake in the game, and eventually, and not very long into the future, C will start getting dominance even beyond the intermediary. An intermediary will start leaving value on the table if it starts making value for the customer. So the power sharing between these 3 will start changing, and we're beginning to see that already. We're also beginning to see this is led by a lot of digital transactions. I don't believe that we're going to move entirely to digital in the high value offerings that insurers have. It's perhaps more likely and already started happening in general insurance, because if you make a wrong decision on, say, buying motor insurance or your overseas medical, it's okay because the ticket sizes are low, costs of switching are next to zero, and so on. So it makes it a lot easier. But for life insurer, you are talking about, say, at least 75,000 to a lakh or more of a regular premium ticket size. Exit barriers are quite onerous. Cost of getting your decision wrong, apart from the premium itself, could cost one literally and figuratively your life. So those aspects are fairly well understood by the customer. India Stack has helped big time. This is the JAM Trinity, Jandhan, Aadhaar, mobility, and now further in terms of account aggregators, national health database, and so on. So a lot that the government is doing, and what we've seen, the payments architecture and that ecosystem is not very long or very far away from the insurance stack. InsurTech's also coming of age. We have several of these. Aggregators are just one part, but you have everything from IoT to POSP to looking at various solutionings in our food chain, from claims, guarantee, assurance on claims, and so on. So and these will be more of partners to the insurance manufacturers than necessarily being competitors. There's no desire for a lot of them to also manufacture, and so this can be a symbiotic relationship. There are also emerging trends that were not long ago. Really, people were not focusing on it, did not think they needed it. Retirement is on one spectrum, and the other spectrum is on covering mortality, so risk of living too long and risk of dying too early. So that is beginning to gain prominence. Yes, there are some headwinds in terms of supply side, but all of these, I believe, are temporary headwinds, because the realization is quite very much there. Inflection point has happened and will only increase when India's per capita GDP continues to increase. So China is today 4x India. So it's inevitable that the average Indian will start worrying about losing something that they have, and how do they protect it. And the regulatory landscape, that's, I'm sure all of you will have some questions on it. So it's suddenly become very pro-growth, no sacred cows in terms of we can't do this, or regulatory facilitation, it doesn't permit you, and so on. So this is opening up a lot of possibilities. We'll have to see as to how many of these really pan out. Against this backdrop, we're talking about especially the established insurers. You're protecting your home turf, as well as with an eye on all the opportunities that are emerging as we speak. And in terms of protecting, yes, diversification of your channels of revenue, as well as efficiency parameters, so that you can continue to build muscle on both technology, new initiative, and customer experience. And how do you look at external threat reduction, whether it is competition, whether it is in terms of risks from possibilities that don't exist today, the Kodak moment or the Xerox moment. Those sorts of things, wherein if regulations today are a moat, and that moat did not exist, what could disrupt your business model? So that's something that certainly keeps us preoccupied, and I'm sure other leading insurers as well. At the same time, all the good things, how can you reimagine insurance if say, health was allowed for us, the health indemnity piece, or if we could have an InsurTech and so on. So I'll talk a little bit more in the following slides. Very quickly, bank assurance and product innovation versus LIC, that has been around for 60 years longer or thereabouts than the private sector. Very clearly, share has been eaten into by the top 6 private players. And you'll see versus FY07 to FY22, 5-6 years down the line, when you're talking about, close to a decade, if I were to go back also, very, very steady in terms of share increase. And this is one other point here is also, I've talked about product innovation, but also the decoupling from markets. Otherwise, there was an inverse correlation that LIC did well when the markets were turbulent, and vice versa, because of disproportionate ULIP that the private sector sold. Now, with weaning off from that, and a lot more balanced product mix, you will continue to see the top 6 players continuing to get stronger. And unless there are some very significant inroads that are made on some of these moats that both these buckets are trying to create. A quick recap, life insurance in India. I'll go quickly in this, but it was important to have a recap, especially those of you that are relatively new to life insurance. And I've heard in the room that some of you are only recently following life insurance. So India, in terms of penetration at 3.2%, forget about it with other countries. Versus ourselves itself, we are a lot lower. We were about 4.6%. So versus that yardstick itself, we are lower. Also, when you look at the density, we are way down at $59. The protection gap, while it has come off, but it's still a very meaningful 83%. This gap is not, it doesn't look like it's going to disappear very quickly. And when you see this in the context of the fact that the average Indian has next to no protection, no social security, and so on from the government, unless you're a government employee. So it is save as you go, pay as you go, and this will start eating very significantly given where inflation is. Also, in terms of the addressable market, this is slightly dated information, but still very relevant, wherein only 1 out of 40 people that need insurance is today, or has some sort of insurance today amongst the white-collared workers. Also, when you look at retail loans, on the other hand, continue to go up, and we are partnered with almost every marquee NBFC bank, small finance bank, and so on. So that's going up. So liabilities, average household liabilities continue to go up. Credit life, hence, continues to do very well. We are the market leaders in credit life, not surprisingly, because of what you see on the right-hand side. And even more important, that people are covered because of their, which was not the case with their parents and grandparents, wherein debt was not a word that was discussed in family households. It was people repaid even their mortgages as soon as they could, did not like being indebted, but a lot has changed now, wherein even small consumer durables, people are not averse, youngsters are not averse to borrowing. Also, the financialization of savings, and this is again the India stack has helped that. Various initiatives by the government has also helped that, and so has the pandemic. So you'll see a very steady increase in financialization, as well as whatever is moving into financial assets. Insurance continues to retain on the right-hand side its share, and this can only go up with more and more, like I triangulated this with increase in per capita GDP, its share should continue to go up. Also, some of the categories that especially HDFC Life has been at the forefront of innovation, like non-par products. Now, what that does is it introduces one more angle to risk management by an average household, which is interest rate risk. And the realization that fixed deposits don't get you there because of the reinvestment risk. So the removal of any ambiguity on what will I get in my old age, or what will I get when I stop earning, those questions are now very well understood by the middle class, and so that category has been born, and hence I'm reasonably confident that the money flow into life insurance will continue to have its share and space and continue to go up. This is the other end of the spectrum. Very, very significant changes that will happen over the next decade. You will see that the life expectancy is continuing to move up. And also, this is very steady. At the same time, you will find that number of people in the very low age groups. India was a very young economy. Now, with the 2 kids, or now increasingly 1 kid, it's not a surprise that down the line of 5 years to 10 years down the line, very significant increase in the people above the age of 60. So slowly, we are getting to be an older economy. We ourselves have a lot of people in our own families in fairly good health and 80 and above. Access to good health care, access to the nutrition when they were younger, all of that is extending life expectancy. So what this will mean is that our pension market is significantly underpenetrated. The numbers on the top right-hand side show it. pension as a percentage of GDP or just the assets. All of that means that people are not saving enough, and inflation is continuing to be rampant. So net of inflation, savings are going to be very low single digits at best. And there is real risk of people outliving their savings. That's not understood today, and even more so if they don't have a home to live in, wherein they're paying rental or mortgage and their home hasn't been paid off, which is a fairly large section of population because they're living in company accommodation or government accommodation or whatever it might be. So that is on one spectrum, and second is they don't have adequate health protection. Often their health insurance is with the employer, group health schemes, so that's not portable. So they start looking to buy health insurance when they're closer to retirement, somewhere mid-50s. It is exorbitant if they can even get one. If they've had some illness, then chances are they'll struggle to get one or get one at exorbitant cost. So all of that realization is beginning to flow through. Life insurance is also emerging, like I said, a preferred savings instrument. It's no longer to say that, let's unbundle. I think those concepts are now just what they are. They're just intellectualization of some concepts. But as a sector, we have proven time and again that even with unit linked, depending on the horizon, that if you were to keep an identical life insurance product versus, some of you might represent some mutual funds here, versus mutual funds, at the end of, say, 6 years, the inflection point is that life insurance will start giving you a better IRR, and I'm not even counting the life cover that is thrown in. So, some of these are just those talking points, but we have disproven them. So people are beginning to understand that, and that's why you see the flows coming through. Moving on to the next section as to how we are looking at in the future, a lot of things that are moving. So suddenly, from being somewhat of a nicely chugging along sector, a lot of things have happened, not only to our sector, but I think a few of the other sectors also, of the possibilities. And a few of the other sectors, a lot happening in banking, in terms of digital banking. We read something every day in terms of crypto, in terms of securities trading, how people are looking at discount brokers. So a lot is happening in various parts of financial services, and so is in the space of insurance. I'll talk about each one of these. When you look at customer experiences, I touched upon some of these, but we're looking at the impatience in the customer, which wasn't the case. Customer used to be okay to deal, or was used to dealing with a black box. Today wants a lot more of pizza delivery, is how we call it, in terms of visibility as to where is my policy in terms of conversion. You already have my data, so why are you asking me the KYC again? How can we piggyback on KYC, whether through account aggregators, which we have just gone live, both to be a information provider and information consumer? How can we look at the India stack or piggyback on KYC by other financial institutions, insurance repository in terms of the information, and so on. They want to be in the driving seat, like I mentioned earlier, wherein B2B is now morphing into B2B2C, and so customer wants to believe that they've made a choice and not a fait accompli. So I do believe that banks that have not opened up, or corporate agents that have not opened up to open architecture, it is inevitable, not because of regulations. That might happen or might not happen, but I do believe that the customer will start thinking that, I've heard of Sanchay Plus, or I've heard of Click to Protect, or I've heard of something else, of some other company that has piqued their interest, but this particular bank assurance relationship does not offer that. So let me wander off to another. It could be an aggregator, it could be the likes of PhonePe, wherever else that they might be in, or like we used to cover with Airtel. So they would wander off to other ecosystems to say, let me check, and there is real risk that you lose the customer for a good part, at least for life insurance. So that information asymmetry that allows 1:1 in a captive bank assurance model, I think eventually will be detrimental, and customer will start demanding a choice. When you look at offline, and so they would look at either looking, talking to an individual and then moving online to buy. What we saw with mutual funds, for example, or the other way around also, wherein you do your research ab initio in online, and then you still want that human touch to say, am I on the right track? This is what I've understood, and finally end up buying in person. Both these are there. You hear about Nike shoes, people searching online and then going to a Nike store and buying the shoe, and you finally want the experience. So both will happen, and we need to be in all these ecosystems, and I don't think we can say this or that. We need to be where the customer is. We need to evolve in the way the customer is thinking about it. I don't think we can sit in judgment to say this is the only right way and I have all the tools and why aren't you using the tools. So this is a nudge journey. This will be a back and forth, and we need to be seamless, and that's why we have we are down the path of 360-degree view of the customer, exactly like when we watch a movie on an Apple network, for example. You start off say, watching it on the weekend at home, and then you're traveling and you see it on your mobile, and you finish the movie or whatever you're watching. So that's the experience now that the customer is not saying, okay, for insurance, I'm okay with a black box. For my movie experience, I want. That's not how the trends are evolving. Also, a lot of social media, blogs, reviews, especially for young customer. So we've launched Clarify Life. Please do look it up if you haven't. It's not a selling pitch. It's not a portal for us to have a push sale or even any kind of sale. It's just to engage with largely younger population to say, how do I demystify? How do I engage with them in a manner that is irreverent, at the same time will talk to them and not talk down to them, and so on. So let us know, when you have a look at it, whether it resonates. But that's something that we have tried to do, so that we are engaged. Working very well in the Instagram, lesser on LinkedIn, because LinkedIn is again slightly older population, but very, very doing well on Instagram. Also, the UI UX needs to be simple, it needs to be intuitive, so that's something that we've just launched Medi Easy, for example. So how do we not ask the customer for a lot of the information? That's what keeps us fairly busy as of now. Also, when you look at product innovation, everything from combination products. What do combination products do? Combination products help in offering a solution to a problem. So you're saying, okay, I will construct this for you. While plain vanilla, you can buy these two separately, but you might not understand or how to do it. And so this combination product that, okay, if you're trying to solve for this, then I will give you these two together, or this plus a rider, and so on. So more and more of this will start happening, wherein you're moving into a solutioning mode from saying, I have a product, I will chase you until you buy this product. Similarly, with savings, I talked about various things, whether it's equity-oriented savings plan. I talked about savings plan even in the unit-linked avatar with higher sums assured, especially for those who are struggling to buy a term insurance because of whatever specifics of their health situation, or pension plans. For example, annuity a decade ago used to be just very plain vanilla annuity. If you look at the annuity avatars today, there are all kinds of avatars, so that people run out of excuses as to why they don't put their money aside for their old age. It could be joint life, it could be increasing with inflation, it could be money back, it could be life, and so on. Same thing in term. If you look at the various versions of what used to be a very plain vanilla, today you have regular premium, limited pay, return of premium, joint life, various additions to it in terms of riders, accident death benefit, and so on. So money back, something that you'll see recently that, from our stable as well, that you survive X years and you can encash your policy, and so on. So this kind of evolving on hearing customers' needs, why people don't buy insurance or why people surrender their policy, we're trying to address that. And then co-created, embedded products, a lot of this happening wherein you're embedding health parts of it, wellness parts of it on a digital platform. You'll see a lot of this as you go. How can you have a bespoke policy? How can you have a cafeteria kind of an approach wherein you drag and drop to say exactly the kind of policies that I want, rather than a plain vanilla policy that, a lot of features I'm unlikely to use. Also, this meeting, you can start off from the physical world and move centrally, or you can start off from what is positioned as a digital world and move centrally. So, and by that I mean that we are understood, or people understand us and our peers as being bricks and mortar, old world manufacturer. But I think the lines are blurring. A lot of us, the senior companies, are now moving center field of, like I said, in whatever form or shape the customer wants to buy insurance, we will be there. Everything from old world, in-person, agency, to, like I just talked about, Clarify Life, engaging with youngsters, giving seamless onboarding, self-claim forms just through WhatsApp insurance, and so on. And then you have the digital avatars. It could be aggregators, it could be some of the other players, moving central to say, now we are opening up branches, now we have in-person connects, and so on. So really, the lines are blurring, and in my mind, it doesn't matter from which side of the field you've started off or you've had your roots. All of us will converge somewhere in the center, and that's the right place to be. And I do believe that Indian life insurance is not going to move anything over 50% digital or any such number, or even a fourth of our business entirely digital. It is going to be wherein there is going to be human intervention that is needed. Even with aggregators, you have call centers. Most of the business is done through call centers, which is a human intervention. Or if you look at the traditional manufacturers, again, we would have large chunks of the process being digitalized, but that doesn't mean end-to-end the customers is coming to our website, customers thinking. That's still relatively small. And when I talk to my peers worldwide, nowhere high-ticket cases do customers come in, figure out what they want, and buy the insurance policy of their choice. Data is the new oil, and we do have a data labs in Bangalore, for example, and this is in 3 buckets wherein we do look at how we can use data. The first one is on new business. I talked about how can we give that seamless onboarding, how can we ping as an account aggregator, how can we ping EPFO. We're right now in the midst of integrating with EPFO through our Provident Fund accounts to figure out what the salary status or the financial credibility of this customer or want-to-be customer is. Similarly, traces, which is our taxes, of course, with customer consent. But doing all of this so that we can connect and have profiling of customers to be able to give seamless onboarding, light touch underwriting, and so on. Second is on servicing. Again, in terms of pre-approved sum assured that I can give, I can pay the customer less. I know that the customer who's called me does not have a policy, but his wife has or partner has, and so on, so that we ask lesser questions of this customer. We also build propensity models in terms of persistency. So we build early warning indicators to say this customer is likely to not pay their policy premium or result in a fraud, and so on. And the last one is on risk management, a whole host of things that we are doing with data, because as we move more and more to digitalization, there is anonymity of who this customer is. And as we move away from the metro salaried customer to increasingly today, the inflection point has happened wherein less than 50% today of our new customer base is salaried, which used to be a very high number, maybe 3/4 a decade ago. So as we move into somewhat uncharted, lesser data, we're trying to build our own data connects to figure out who this customer is and how do we do differentiated underwriting. While we do all of this, and regulators also talked about, and I talked to some of you just now, regulators talking about growth and so on, but it is important for all of us, and I'm sure the regulator is also looking at this. It is important for us to look at risk management aspects also, and not only the top line aspect. Growing top line is not difficult in insurance, in life insurance. It's a function of say price, how much risk you're willing to take on your balance sheet. But we're not selling soap. We're selling very long-term policies, with selling 15, 20, 30-year policies. And some of this will really unwind over a period of time, long after the CEO is gone. So what is the quality of the back book? What is the quality of embedded value? I think those questions need to be asked and worried upon also. because some of this creeping through in terms of poor quality, next to no underwriting, those trends are not beneficial for anybody in the sector. And this has happened in other parts of the world, and then there is a correction that happens because of disproportionate focus towards top line. Why would HDFC Life, for example, say no to any kind of business? It's because we are not very sure that why should I give light touch underwriting to this individual when I've been writing this business for the past 10 years in term insurance just because somebody else is willing to write that. Why should I write this business if today itself I know my margins are going to be at best 0%, but most likely negative. Because the customer, when you increase the prices, the customer is going to gravitate away from you to someone else. So I think triangulating between top line, bottom line and quality of business, including risk management, is very, very required for the long-term orderly growth of this sector. Many moving parts. Sometimes we hear it for the first time on media. So, whether composite license is something that is being talked about now. This was, by the way, I was part of a committee for at IFSC as part of GIFT City, and that's something that we had put through as a suggestion. So this is something that's, we haven't had discussions with the regulator, but there are some media reports on this. Health indemnity is something that HDFC Life has been at the forefront of asking for it, not just to play in the indemnity space, but this is one missing piece of our offering so that we can give end-to-end offering to the customer, right from this health indemnity to fixed benefit like cancer care, cardiac care, to wellness, to end state in terms of covering for the eventuality, so that the customer does not have to buy 2 or 3 different policies for this objective. Also, access to health data, that's a crying need, and that's where our underwriting is a lot more complex than what banks and NBFCs go through, which looks at the financial underwriting. We have to look at both financial underwriting as well as, and even sometimes more importantly, medical underwriting. Because it's very finely priced, and if you get it wrong, even a few lives going wrong in terms of your calculation can leave you in a deep shade of red. Risk-based capital, what are the timelines to move? This will help release a fair bit of capital and hence perhaps take the pressure off in terms of supply side constraints that the sector is feeling from what reinsurers are going through. Sandbox also, we are seeing some relaxations. It wasn't very successful because one had to withdraw it after an X number of months, including the policies that you have sold. So some relaxation that we're beginning to hear. Open architecture, there's an exposure draft now allowing for 9. Fintech subsidiary, this could open up a lot of possibilities. If this were to happen, you will hear something in the HDFC Life space. We are ready to press the button, but I will talk a little bit more about it as, once this clarity comes through. Can we invest abroad, both in terms of assets under management, which we can't do today, as well as subsidiaries abroad, which is on tap, or any other such combination? By the way, we are the first ones to set up shop in the life sector in the GIFT City. Why have we done that? Because we do have a reinsurer subsidiary in Dubai, and we can have bespoke, maybe dollar-denominated coverage for NRIs, or we can have health indemnity, which I'm not allowed to today to do here, but this could be a DFSA approved product. So various optionalities that open up because of the GIFT City route. Also an aggregator model, which is, and we have talked about this at the Life Council level, wherein what is stopping us, all insurers or whichever insurer is willing to again join hands to say that this is you can come here, you can buy similar to any other aggregator, for example, and maybe have some things thrown in as to why the customer should come in. Of course, it will also have a seal of approval because there will be no push sale in here. Customers can come and buy whatever they want to buy, and we could start off with term insurance, for example, with a comparison site. So this is my last slide. This is just the beginning of a very large opportunity. We talk about insurance, have we maxed out? And this really puts things into context. We're talking about very large size insurers. I'm also I'm also asked about valuations. And when you look at Ping An's valuation, what it was when they listed and then say a decade after they listed, or even 4-5 years after they listed, which is where we are today, the valuations were not very different from where we are. And given the size, India will take a fair bit of time to get there, but the opportunity certainly is there, given some of the things that are likely to happen very, very rapidly in the Indian life insurance space. So I'll stop here, and hopefully this gave a good overview. Happy to take questions.
We can have questions now.
So it was a great presentation. Thank you for the overview. So I would like to get some clarifications regarding your ESG investments. So
Sorry, ESG investments.
ESG.
Yeah.
So when we look into your responsible investment policy, so there's this ESG analysis which is done in-house, I believe. So first of all, just like mutual funds right now, will HDFC Life in future take the scores from other proprietary agencies which are out in their market? Second, is there an exclusion list which HDFC Life follows, like it will not invest in certain sectors of the companies? Thirdly, is HDFC Life looking to disclose or put out CDP disclosures as has been done by HDFC Bank for certain number of years?
So on the first one, about using external people, we always use a mixture of in-house and external. And we have done that already for some parts of our integrated report, ESG and so on. So we'll continue to evaluate that. We do talk to a lot of investors. We do talk to ESG focused funds on what their expectations are. As recent as yesterday, we had some exchange with one such investor in us, and we'll continue to do that. Second aspect, in terms of exclusion list, we find that life is never cut and dried. For example, I sit on Tata Power board. And one could say that, this is coal and you exclude, but when you look at, as long as the management team is making very significant inroads into saying, okay, this is my plan, this was my legacy, and at that time the legacy was thought to be right. Now, most of my investments are going to be in renewable energy, for example, and so on. So we do take a much more nuanced approach. We do engage with management teams of some of these companies. Of course, we have some sectors that are on a watch list. So nuanced approaches is how we look at things. And some of the things as HDFC Bank, all things being equal, is going to be our promoter, and we will follow our promoter definitely. Yeah.
So if you see the assets wise, same thing, 4 times, even the assets are 4 times. Now in case of Ping An, it has health insurance. So do you also get into health? Second, in China there are 235 companies, India also there may be 200 companies doing life one day. I mean, government will give license to everyone. So, but China, if you see 4 companies dominate, 8-90% of the share, while India, LIC dominates India is 600 billion, they are 2.4 trillion. Now, if you see...
Can I take one question at a time? Because
no, the question is only one. That would India also, you also would eat up market share from LIC? That's what would happen? Because penetration-wise, it's very similar. And second thing, would you get into health?
So answer to both is yes. So on the first part, like I mentioned to you, we have been at the forefront. We've been engaging with the regulator, after which a committee was formed. I was on that committee, and there was a report that was submitted. We are yet to hear back. It was 18 months ago. We are yet to hear back from the regulator on that. But again, with the new regime, the regulator, they seem to be supportive. And like I mentioned, if that were to happen, we will look at how can we distribute other health products. Can we incorporate? What really interests us is the fact that this will lead to further product innovation. Like I said, today, if you were to look at buying Mediclaim, you buy it from either a GI or a Sahi. If you were to look at cancer care, cardiac care, you come to us. Health savings, you come to us. Overseas medical, you go to GI. So God forbid if there's a claim, then the nominee has to go to 3 different entities. So we really need to keep the customer in the center of things to see how are we solving for this. Also, medical data is something all of us are hungry about. So today it lies in different pockets. So absolutely, in terms of both manufacturing, distributing, innovating with health, we will do it in a calibrated manner. And also, how can we incorporate wellness into it on a digital platform? So that's also something that we have initiatives running internally. On LIC versus, I showed you data that it's already happened wherein there's been a slide. Now, it could have been even faster in my view because the avatar of LIC was very different in terms of largely participating, largely very low share capital and so on. When it truly becomes a, when I say truly listed company, more than 2.5% and so on. So I think some of those advantages in a way that was there perhaps will not be the obvious advantages. We will continue to, through product innovation, nothing else, but through product innovation, through the focus that we are having on outreach, I think that will continue to happen.
Yeah, ma'am, actually I have multiple questions. I'll go one by one. There was a point on your slide on cost efficiency. So could you maybe elaborate a bit on that?
So what is important is that the back book, the cost of running the back book has to continue to go down. It is also well known and well appreciated that in India today in insurance, cost of acquisition, new business acquisition continues to be high. But how will you keep funding that, assuming your parent company is not going to leave money on the table, like I mentioned earlier in terms of not having open architecture at banks. Short of that, one has to fund yourself. And that's why we are very, very focused on having positive operating variance on our back book. That is important. So my cost of my collection, cost of servicing, all of that has to continue to go down so that we can keep investing in new business as well as technology.
Specifics that you want to mention there, or what are we exactly doing to ensure that those efficiencies or the positive variances keep on coming through?
Absolutely. So for example, a few things on claims. Earlier we would have had somebody walks into our branch, our person services, takes the entire chain of people before a claim is settled. Today, if it's not an early claim, a person the nominee can take a picture of the documents and upload it by WhatsApp and should be settled within 24 hours, less than 24 hours. So that is several such examples. Similarly, a person today, and thanks to COVID, and also thanks to the fact that we were focused on some of these digital initiatives, there is no reason a person today has to walk into our branch at all. So if the customer is willing, we can send a link, customer can be in the comfort of their homes and get service in terms of whatever that they want to do. It's the customer that wants to walk into a branch, that's okay. We will also be there. So everything from cradle to grave. Similarly, in terms of even new business, while I'm talking about policy servicing, but even new business, today we have a platform called Wise. We've had it during COVID. We launched it just before COVID, wherein you can do everything as you can do sitting in front of each other. Right from soliciting, right from running illustrations, bespoke illustrations, and then pitching the product. And if the customer is happy with that, to say, okay, let me go through whether you need to do medicals or not, let me fix your medical. If you're eligible younger life for telemedicals, let me do that. If a person is not salaried, for example, and there's some complexity in terms of financial underwriting, there is a CA desk, transfer to the CA desk, all in that one journey, all recorded. So even for posterity in terms of missale complaints and so on. So that's the kind of journey which will ensure that both there's customer convenience as well as for us to do high volumes at much lower cost. And last is on underwriting. A lot of questions and turns that we're doing on our back book in terms of upsell, for example. We can give pre-approved, sum assured and so on. So how can I do more of farming rather than only focused on hunting, the way the life insurance industry has been focused disproportionately on hunting. As our back book grows, for us to be able to do. All of that will help sweat our back book a lot more and thereby help us fund new business.
So I'm not looking for any guidance here because we are obviously talking very, industries yet, because just If any quantification
Oh,
there.
absolutely. Please
Yeah.
look at our just one metric for the past 10 years. When you look at our operating variance, that's the moment of truth as far as your back book is concerned. Whether it's in terms of claims, whether it's in terms of persistency or in expense ratio, all three combined, that you will see a small positive variance, except in the year of COVID, wherein we have called it out separately.
And like today, when we see actually, because of the way the bank, you also mentioned this in your, in your, session that the bank assurance obviously is very different for different insurer today. Some are not open, some are open, and that obviously seeps into your OPEX. Getting benefit to one versus the other. Because of the things that you're mentioning right now, could there be a substantial reduction which can actually help specifically, like, the ones who are into an open architecture versus who are not? So that you can maybe bridge that gap on the operating side versus maybe, your peers.
I didn't understand. So,
So
you're
like today,
saying
your-
reduction in our
your reduction,
expenses?
yes.
Because of HDFC Bank.
Not exactly HDFC Bank, but maybe because you are at a lesser advantage versus maybe a SBI or an ICICI who've still not gone into open. So, that operating cost is obviously a little higher for you versus them because of the banca channel. So because of the initiatives that you just spoke, could there be a very substantial improvement which can help you bridge the gap with them?
It will help bridge, it will not eliminate. There is an artificial structural advantage that is there. It is too large for us to bridge. And yet we are, I think what is important is the margins are not very different, despite a very large structural advantage. So I really see on the other side, wherein open architecture has not been embraced, that it is an artificial construct. And the margins then should be significantly higher. And I'm talking, it should be 50% margins and not closer to 30% margin with that artificial construct. So the question that needs to be asked is, why aren't their margins 50%? Maybe we can take some more questions and come back if anyone else. Yeah. Yeah, please go ahead.
Yeah, ma'am, so I just want to ask about the APE growth for HDFC Life. In the past, in the recent months, it has just come out 2 days ago. We've generally been the most consistent, growth numbers in the private life insurance industry. But in the last 4 months, and in the recent month as well, our numbers have been kind of declining in terms of APE. So, will HDFC Life be able to attain the full year guidance of 15 to 20% that we've given? Because that is the overall TTM basis growth is also going on the lower side of the guidance. So
Yeah, I think so, because first quarter we did achieve 15 to 20% growth. That should that's very much on the cards. Now, yes, some quarters will be up and down, and that's why my earlier point in terms of it's not, getting to the growth numbers is not that difficult. What is happening today is that this triangulation between growth and risk is somewhat diluted, and it will take some time for the industry to go back to basics, especially the mid-tier players, wherein if you look at the risk on their balance sheet, that has significantly gone up. I think people don't pick up that number from IRDA's annual report, wherein you will see risk on the balance sheet going up from mid-20s to mid-30s. The question to be asked is why, especially on a much lower balance sheet. Life insurance is not like general insurance, which is a one-year product. So this triangulation, also there is next to no disclosure, especially mid-tier players, and that's an ask that we have as a senior player with IRDA, that it is important, given that statutory auditors don't audit the liability side, and there's a disclaimer to that effect, unlike in the West, then at least there has to be an annual disclosure of embedded value walk. Indian GAAP really tells us next to nothing, and this can be a race to the bottom. And so it's, again, if one is willing to play the price war, one is willing to retain more risk on the balance sheet, one is willing to not ask any questions when it is staring. I'll give you an example. 55-year-old man, LFT, the lung function test hasn't got through. There is an issue, but the individual is an HNI. We're talking about anything between 50 to 100 crore cover. the practice today is that if you guys send him again or her again for retest, then that business will get converted somewhere else. And this happens, and we know this for sure because it does happen in a multi-tie, and you know that this business has moved elsewhere. So we will stay, focused as HDFC on what are we seeing today. Banking sector went through this. Banking sector went through, in terms of credit cards, really race towards giving cards more and more without looking at the underwriting, without looking at capacity for that individual to repay cards. And today what you see is very different from what you saw, say, 7, 8, 10 years ago. Insurance, I think life insurance, I wish it doesn't happen, but I have a reasonable sense that that will happen. So this race towards not asking the customer anything when, we've been the leaders in this space, say on pure term. We ask the questions, back to basics, that if we have no reason to believe that mortality trends are going to be significantly different than what we have ourselves seen in the past, not some other data we ourselves have seen, then why do we believe it's going to be significantly better? The pricing is so fine that even if one individual were to pass away more than what you have priced, you're going to be in loss. One individual, right? And you're often talking about risk retention because reinsurers are not happy to retain risk retention on one's balance sheets. Again, this is very different to banks, wherein or NBFCs, if you lend $100, you're going to lose $100 plus interest. Here, we are going to lose 400 times that $100, right? So I don't want to paint a gloomy picture. All I'm saying is that it's not loss of strength of distribution. It's just we are staying focused on core basic principles of underwriting and growth. You will see this coming back on. HDFC Bank, for example, it's a matter of time before, like I said, they become a promoter. HDFC Bank management has talked about the fact that this will be like a parent-child relationship. So it's really a matter of time on how that alignment starts happening. Both the large players don't have open architecture. So some of these are artificial constructs. And yes, this will happen for some time. I do think that, large players have slightly different construct that because you have open architecture, because you don't have open architecture, your cost of acquisition could be significantly lower, right? Because your cost of acquisition is lower, you can afford to sell 75% unit-linked products. Unit-linked products would, we do sell, we do think it's a good product, but it is typically sub 25% of the business. At 75% of the business, you can sell unit-linked product. Because you're able to sell a lot more unit-linked products, you would be number 1 or number 2 in the ranking, right? So it's all linked to not having open architecture, right? Leaving value in the insurer. Nothing wrong with it per se, but are you giving customer a choice? And will eventually customer wander off elsewhere because the rates are not competitive, for example. So that information asymmetry is something that is that something that customers will be okay with down the line is a question to be asked.
Can I take one last one?
Yeah.
Thanks, Vibha.
Maybe last two, I think this lady here, and yeah.
No, we're over time. So you made a very interesting point about intermediary power coming down. I hope I heard that right. If we were to look at it as outsiders, what pointers can we look at in terms of the data that you give out to take comfort that progressively we are becoming better on that front?
So, in a way, the most advanced intermediaries, contrary to popular perception, are our agents, our individual licensed agents. Contrary, because they're the first ones to adopt a lot of our innovation, one of the highest in terms of term, one of the highest in terms of annuity, one of the best persistencies, despite, so again, it's going back to basics. So for example, we've had our senior agents say that, okay, I will charge you less, but you give me a better price for the customer or lesser underwriting for the customer, whatever, value proposition to the customer. They have started having conversations with us. And that's what is making us think that they are also facing competition with other channels and other channels with them. So there is also a fight for the pie. So they're saying, you give me bespoke and I'm willing to leave money. Obviously, we have zero tolerance towards rebating. So that earlier what used to happen, there still are a lot of companies wherein the first year premium is given back to the customer. We would sack our employee because that's illegal, right? So another way of doing this is to say, you give a better value to the customer, I will charge you lesser for it. So this is only the beginning wherein the pull of the market will start happening. It will take time, but they've already started having conversations with us on this. So sorry, last question here. Yeah. The first one is on risk-based solvency. It is important for us to be able to release some of the solvency. And also there is a mismatch in terms of how assets liability accounting is, little bit technical. That is important. Also, FinRe is very important so that some of these products, if we can reinsure and take it off our balance sheet, that is important, will give us capacity. Second aspect is for us to be able to invest in InsurTech. That again opens up a lot of possibilities, very meaningful for us. Third is for us to, on health, again to complete our offering, and you said top 3, but fourth I think would be in terms of for us to have ways in which we can use health data. That is important because the more visibility we can have on health data, the better underwriting we can have. I have to stop here, guys. So thank you so much for being here today and a patient here.
Thank you for this enriching session, Vibha. KK sir, could you please hand over the token of appreciation? उनका लैपटॉप देना होगा उनको हमारा था कि उनका है अपना ही है ना Can you turn the lights? Yeah, I'll take it, thank you. Hi everyone. So next we have the management of Samvardhana Madansan Group. We have Mr. Vivek Chand Sehgal, Chairman of SMG. He chairs the 10 billion Samvardhana Madansan Group, which was set up in 1975. The group is ranked 21st among the world's largest automotive suppliers and supports its customers from more than 270 facilities across 41 countries, with a team of over 150K dedicated professionals. He has facilitated the group's growth with a focus on global expansion through both organic and inorganic initiative. Mr. Sehgal started off as an entrepreneur, but now has succeeded in building a vast empire. The group started off as a producer of auto components with formation of partnership with Sumitomo Electric. All of the Motherson acquisitions such as Vigio Corp and Pegu Form were the result of their clients' recommendations. Most of the acquisitions were financially troubled, and Mr. Sehgal has successfully managed to turn them all around. We also have Mr. Kulan Marani, who heads the strategy and M&A at the group. He has over 2 decades of experience in global strategy and planning, mergers and acquisitions, financing, investment banking, and assurance. Prior to joining the group, he had led teams in the Asia-Pac region at pedigreed firms such as Merrill Lynch, Bank of America, IIFL, Ed Kearney, and Arthur Andersen. He also has been associated with Motherson Group since 2013 as head of global strategy and M&A. In his role, he has led teams in the evaluation, execution, and funding of organic as well as inorganic growth, initiatives of the group. The team will make a quick presentation on the outlook and the growth of the group, which will be followed by Q&A. Over to you guys.